PIMCO's Bill Gross is making lots of changes these days. The manager of the world's largest bond fund has been lightening up on treasuries from his flagship PIMCO Total Return Fund. Now he's starting one that relies less on derivatives and leverage. It will be called the PIMCO Total Return Fund 4. Bloomberg stories on that this morning that you can read. But he joins us now live from Newport Beach, California. Bill, I want to talk about the changes to the business in a moment. But first off, you made it into the office this morning. Is it business as usual at PIMCO, given the warnings about waves hitting the shore there?
It is business as usual, and business as usual in our Tokyo office as well. So both are well. The tsunami is expected to reach California shores shortly, I suppose, but we're well above the water line, and I think public agencies have done a good job in terms of alerting the citizenry here in the local area.
Okay. Well, I'm glad to hear that. What happened overnight in Japan? I mean, put this in perspective. This is the third largest economy in the world. Does the hit to the infrastructure, does the hit to business there change your global thesis?
Well, I don't think so. It changes to some extent our view in Japan. As Mr. Rabini pointed out earlier on your broadcast, Japan has a very high level of debt to GDP, and this will exacerbate the problem. How much, we're not quite sure, but certainly infrastructure spending and continuing low rates of interest from the standpoint of policy ultimately produce slightly higher rates on the longer end. The markets there closed, I think, before the tsunami actually had a chance to affect them. But we should look on Sunday night for them to open higher in yield.
Mm-hmm. The central bank, they're saying they're committed to ensuring liquidity and stability. What is it that they should be doing?
Well, they should be doing just that, and ultimately the rebuilding and the infrastructure spending will be determinant in terms of the longer ends of the curve. For instance, right now the 30-year Japanese swap rate is around 2.20%. Obviously, that's not a bad rate compared to the deflationary environment that they have, but ultimately Japan, in addition to this rebuilding, has demographic problems, and I would expect this to bend upward, that yield on the 10, 20, 30-year swap rate, perhaps not by much, not in panic proportions, but gradually by 4 or 5 basis points on Sunday evening.
Gosh, well, let's talk about what's happening here at home. Treasuries are headed for a weekly gain because you've got these global worries, people seeking refuge. Why are treasuries not necessarily a place of refuge for you?
Well, I think it's a question of valuation. Obviously, the U.S. government is a AAA credit, will be a AAA credit for some time going forward. And so it's not a question of departing treasuries based on credit fears. It's simply a reflection of the value of treasuries relative to other sovereigns or corporate bonds or other issues in the marketplace. To cite a few examples, the 5-year real interest rate in the United States on the 5-year tip is a negative 20 to 25 basis points. Historically, that's been more like 1.5% to even 2%. And so you can see from that example alone that yields are, perhaps 150 to 200 basis points lower than they normally are on a historical framework. To some extent, from our viewpoint, that's been a reflection of the purchasing power from QE2. To some extent, it's a reflection of the extended period of time in terms of the Fed. But ultimately, there are better choices than treasuries.
We're continuing our conversation with Bill Gross, manager of the $237 billion PIMCO Total Return Fund. Favorite guest of ours here. Bill, I want to pick up where you had just left off, and that was talking about what happens after June. In your investment outlook, you said that if we don't see substantial unemployment reduction, we don't see more stable dollar and confidence return, QE2 will be considered a flop. How close are we? How do you gauge our progress?
Well, we're doing fine right now. I think, Fed President Dudley of the New York Fed this morning expressed confidence in the economy going forward, expressed confidence in job growth going forward and low inflation. That to some extent is a little optimistic in our view, and there are legitimate concerns in terms of liftoff, that is the ability of the private sector to stand on its own two legs, to generate jobs now without the thrust of government policy, be it
right.
A $1.5 billion deficit or QE2 or low extended periods of time for policy rates. So there are legitimate questions, and so Fed officials and others have to proceed cautiously going forward. The June 30th deadline in terms of QE2 is sort of a cliff type of effect and not necessarily cautious, and so as we approach that, we need to be cognizant of the potential effects on interest rates and on the real economy itself. It is a question mark.
Yeah, and you've lightened up, as you said this week, and got a lot of attention for it. You've lightened up your exposure to treasuries. So you still have about 20 to 30 billion, I believe, under management. How high would yields have to go for you to once again be a buyer for the total return fund of government debt?
Well, let's put this in context. I mean, an investor, a saver, should be rewarded for the liquidity that they're providing and the risk that they're providing relative to inflation. Historically, a 10-year Treasury investor has been rewarded with a yield that approximates nominal GDP. That's a long-term history and subject to cyclical variations, but if nominal GDP is in the 4 to 5% range going forward for the next 12 to 18 months, which is the Fed's forecast, then, a 10-year Treasury should be rewarding investors with a 4% type of yield. We're being under-rewarded at the point in time now at 3.5%, and so, let's move into other markets, I guess, is PIMCO's, favored type of direction. Let's look at other sovereigns with higher yields. Let's look at corporate bonds that haven't been subject to the QE2 types of policies, which have lowered interest rates artificially.
And Bloomberg's running that story this morning, saying that you're launching a new version of the total return fund that's got somewhat of a more conservative approach. Where's the demand for that? Why are you doing that right now?
Well, I can't talk about that because that's what they call a quiet period. The SEC would be all over me, but I know your article this morning pretty well put it out in print, and listeners and readers should look at that.
All right. A little bit of a plug there. We'll take it. Thank you very much, Bill Gross.
You're welcome.
Thank you. Good luck, and good luck in getting in touch with all of your employees there in Japan, as you mentioned.
Thank you,
glad to
Margaret.
hear everyone okay at the moment.